Mike Tedeschi, Portfolio Manager over at Perspective Wealth Planning with this week's market breakdown video. We're going to take a look at the four major U.S. indexes. We're also going to jump in and take a look at the U.S. dollar and commodities as well as bonds. And you guys know how important we think breadth readings are. Well, there is a breadth reading thing called the Titanic Syndrome that we're going to take a look at. Essentially, this looks at when an index makes new highs, and then within a couple of days, more stocks in that indexes are making 52-week lows than 52-week highs. It's another way of looking at breadth, saying fewer and fewer names continue to lead us higher. And we're going to take a look at that data set and what that could mean for us moving forward. Now, from the beginning of the year, the market has not fared well. The S&P 500 is down about 6% since the start of the year, but we have not broken any major levels. So when we look at the S&P 500, we talked about 4,500 as being really, really important. That was the last low that we had from back in December, right? And that's essentially where we saw this breakout from back in October as well. So this is the area that we've been watching very closely. If we break underneath 4,500, that next stop is that 4,300 zone. And that's that really important level because not only do you see that from 10.4, but it was also back at 8.2, and then all the way back into June was the breakout. So this line right here is really, really important. And that's the one where if we break, I think our uptrend can kind of be negated at this point in time where we would no longer have that series of higher lows in place. We would still have higher highs, but then we'd have lower lows, and that would put us into that choppy mess. That's not really what we want to see. But we're still trading above that 4,500. This is still a ways away, so we don't have to worry about that just yet. How that market reacts right here is really important. If we can hold on to that 4,500, there really has been no damage done to the S&P 500 at all. We come in and we take a look at the NASDAQ. The NASDAQ actually broke below that range. That was that 15,600-ish zone. That's where the breakout happened. And it had been trading between that and about that 16,700 level for the last couple of months. It broke below that, but you guys will notice here we did not go and make a lower low. So that zone on the NASDAQ, like 4,300 on the S&P 500, is actually all the way back here at 14,000 to that 14,500 zone. So as long as we hold above that, we're still fine. And if we still look at what this chart is, this could still be a series of higher lows in play, which is still classified as that uptrend. So while the action has not been good to start this year, we haven't broken any major technical levels on the NASDAQ. Next, we come in and we take a look at the Dow, right? The Dow, we had that drawing on there from last week saying a series of higher lows still in play, and that's still the case. Right? This is still the case. We still are in this potential uptrend, but really, and we've talked about this a bunch, the way that we have looked at the Dow and continue to look at the Dow is more like that of the Russell 2000, where it's been in a long range for a long period of time. Okay? This is obviously much stronger than the Russell, but from a trading standpoint, the Russell is basically in a range from the beginning of last year, and this really, it took until April till it got inside this range. As long as the Dow stays over 33,000, there's nothing wrong with this. Look, we had an incredible run up. We all know this, right? An incredible run, and then a sideways range. There's nothing wrong with that. This is digesting that move, and you would expect after such an explosive move off the bottom, a year or even two of trading sideways inside of a large range would be perfectly normal price action and behavior. Right? What becomes concerning is if we don't hold above this and after a year or two of digestion we break below it. That looks really, really bad. So that's why we're paying so close attention to this zone. And when we look at the Russell's actually in potentially dangerous waters if it pushes any lower here over the next few sessions. We talked about that 2050 level multiple times over this last year. This is the range. We have traded inside of it. Every time we've come down to the bottom of the range, we've made that bounce immediately, right? We are now testing the bottom of this range right here. We need to see that bounce because if we don't, what we've got is we have a false breakout and then a breakdown. That would be a very bad sign. And the Russell, because of how explosive it was toward the end of 2020, really doesn't have any support until that 1700 zone. That's the last really price action area that we've got. You can see that from the beginning of 2020 and then this zone right in here. So If we lose this here, there is potentially a long way down, and after such a long period of time trading sideways in this zone, not being able to break to the upside and sustain that move is very concerning. So I've said it many, many times over the last year. I think the way that the Russell ultimately breaks here is going to have a bearing on the overall market, because we know we look at the mid and the small caps as that risk-on environment. And when those are performing better, that means people are willing to take more risk with their capital, and that tends to bode well for the indexes as a whole. We're going to continue to pay very close attention, but this is what I would be watching, guys, throughout the course of the next week, because a break below and a close below here on a weekly basis would be a big red flag for us, and we're right there on that level. So important to pay attention. Now, let's take a look at the U.S. dollar. The U.S. dollar, as we know, and we've talked about this extensively, that 97 level is important. On a long time frame, that 89 level is important. We have a potential, and this is, if you're a dollar bull here, this is what you're looking at. This is a potential cup, and maybe this is your handle, right, over the course of a year or so. Here's the thing. This pattern doesn't matter unless it actually resolves higher, so we're still watching this 97 very, very closely. We had the dollar break down, and what did it do? It found support right where it broke out on 11.8. All right, so this could be that breakout back test. It's holding right here, and we could see that next move up. If you're paying close attention to the dollar, this area here is really, really important on a support side. You lose that, then we have potentially 93 and 92 on the way down. But since we've held that breakout spot for right now, we would look at this as that potential move back up towards 97. Really, when we think about it, between here and here is just a range, and it can bounce all around in here, and we don't have a clear winner. A move above would be a clear winner for the bulls, and a move down would be a clear winner for the bears. In between, still kind of that choppy mess. I don't see anything to do with the U.S. dollar, but as you know, we always take a look at it because all of our commodities are priced in U.S. dollars, so a stronger dollar, headwind, and a weaker dollar, a tailwind. Let's take a look in at the energy space. Right, oil is attempting that next level breakout here, guys. It's now over that 85 level, and I'm going to back this chart up. We'll look at it on a monthly basis. Here it is making a higher high once again. So from that bottom, we have just pushed straight up. Our next real resistance zone comes in right around that $100 area. There, of course, is a psychological reason for that as well, not just a price action reason for that. We know when numbers get to that large round number, it tends to be an area where people make decisions from a psychological standpoint. So that will be the hurdle that we'll be looking at here this year. Energy names have outperformed the index substantially so far in 2022, and this chart of oil can kind of show why. When we look in at gasoline here, right, we see a potential for a breakout as well. It did not take out that September high yet. I'm going to zoom back in on a daily chart for you guys so you can see a little bit more in detail. We need to get over that 252 on gas to get that break and then get that push. And as you remember, we have a big wide range, basically up to $3. So let's pay very close attention there. Nat gas has had an absolutely wild month. Look, they call it the widowmaker for a reason, right? The volatility in the nat gas contract can be outstanding. We had a move on the 12th. It was up about 13-14% for nat gas. The next day, it gave it all back, right? And has now had another couple of days of slide. The levels that we drew out on the chart, perfect so far. That 350 is support. That 480 is resistance, right? So we're going to continue to watch that. But this chart is not nearly as interesting as it was a month or two ago. And as you know, we pointed out many, many times that we needed to hold over this $5 level, or there was a chance that we'd see that big slide like we have every time over the last 2 decades, or last decade, where we popped above that $5 zone, right? It's the same pattern. So watching that 350 very closely. Now, let's jump in and let's talk about our precious metals. They saw some signs of life for the first time in a while over the last few days. Gold is back up over that 1840 zone. It's only been over that for 5 or 6 days in November of last year in the last 5 months. So this is a big level to hold, and really, we have them laid out on the chart. I want to see gold back up over 1900 to get really excited about the space. When we look under the surface at some of the other metals, we saw some really good outperformance there as well. You have silver up nicely now. It went from 23 to 24.5 in 3 days, and it's pushing back up into this level. Over 25 is really important there. We look at palladium, which we know have had so much problems here over the last 8 or 9 months, had a strong couple of days. But platinum, the other one that we really like to pay attention to here, really strong action here over the last couple of sessions, picking up almost $100 an ounce in 2 days, and is back over that 1,000 level. 1,100, you can see that line on my chart. I'll go ahead and make it a little bit clearer for you. 1,100 to 1,150 is that next really, really important level for platinum. Look, when we talk about ranges for prolonged periods of time, and that next move is really important, gold can kind of be looked at like that. We had an incredible push higher and then a digestion of the move over the course of a year. If gold and the precious metals can get going here in the beginning of the year, you could have a continuation of that original move into that, and that's the reason why we're paying so very close attention to it. We also want to jump in and take a look in at Bitcoin real quickly for you guys as well. That key 40,000 level has held. You had a really nice bounce from 40,000 up to almost 45,000 in a couple of days, and then we kind of had that slide back. Bitcoin here is just kind of sitting on that level, and we know the price action at this 40,000 is really, really important. Basically, we've tested this price action zone many, many times since last May. If we lose that 40,000, a move back to last year's low of the year in that 32 to 28,000 range certainly could be on deck. So this is a very important level for it to hold. And when we just do a real quick look at essentially what's happened here since November, it's just a straight downtrend. We have not broken out of that yet. To break out of that, we really would need to get back up over that 47.5, and really to make a higher high, we would need to break over that 52,000. So this market has been under pressure this year and has a lot to prove from here. Now, the Titanic Syndrome is one of those breadth readings where in the last 40 years there have only been 4 times where we have seen this play out with the level of ferocity that we've seen here in the last 6 months. And this, again, is indexes making a new high, and within days, more stocks making 52-week lows and 52-week highs. So there's not a ton of data set behind this. But the times that this has occurred have been major peaks in the last 20 years. So this happened in 99 and 2000. It happened again in 2007. And then it also happened in 2015, which didn't mark the top of any of the U.S. indexes. And now it's happening once again. So it's something that we want to pay attention to, because of when we have seen this in the past, it has marked turning points in indexes. So the number of days where we had that occurrence, right, at the end of this year, now we're up at around that 35 level, right? That is close to what we saw back in 07 and 08 and in the dot-com bubble. And in 2015, we saw global indexes perform really miserably for a little bit there. Not necessarily just the U.S. indexes, right? And so when we look at the actual data points behind that, what is interesting to note is that out to 6 months later, we didn't have any major pullbacks, okay? But 1 year later, that's where we saw those incredible sell-offs there in 2000, in 2007, right? Again, 2015, the market was positive a year later. And in 1999, we know the party lasted for at least another year before things really fell apart. So this is not the end of the world for us by any stretch of the imagination, but it is certainly worth paying attention to, because breadth readings are so important. If there are only a few stocks participating, that means we don't have a broad-based rally, because what you see in very healthy markets is rotation, right? One leader kind of steps back a little bit, a new leader emerges, and we continue to grind higher. When we get towards the end of moves, we tend to see only a few names holding things up and nothing coming to replace them. And when those names finally start to fall, that's where we get the topping action on the indexes. We're not there yet. We're still above our key levels. The Russell's right there on that super, super important level. But it is certainly worth continuing to pay attention to here. And the last thing that I will leave you guys with is bonds. We are really closely paying attention to the bond market right at last year's low of the year. So last year's low of the year happened in March. We came down and we tested that level right here, right? This means, if we break below this, we're going to continue to see rates rise. That could be an issue in a lot of different areas of the market. For example, if you think about mortgages, as rates go up, mortgages become more expensive, and you typically tend to have an inverse relationship between home prices and those interest rates. So home prices have been on the rise. The housing market has been extremely hot. If we see a quick rise in rates, that could tamper that market, and that, is another piece of the puzzle. So let's pay very close attention to rates, and let's pay very, very close attention to the indexes on those major levels. As always, I hope you guys have yourself a fantastic week and you found this information helpful. You can always reach out to me at mtedeschi@perspectivewealthplanning.com. I'd love to talk with you about anything about the markets, and I will see you guys next week. Take care.